Hello everyone, I hope you are all doing well. Today in this video I'm going to explain you guys about how to record under the double entry bookkeeping system. I'm going to give you guys some examples of the transactions. Okay, for now I'm going to make a quick recall of what are the type of ledgers and how are we going to decide where to record in debit side or in credit side. Okay, so under ledger account there are two type of ledgers, personal and impersonal. Under personal there are owner related accounts and not related to owner accounts. Under owner there are two accounts, capital and drawing. Capital is always a credit nature, drawing is always a debit nature. Under not related to owner accounts there are two accounts, receivable and payable. Receivable is always a debit nature, payable is always a credit nature. Under impersonal, sometimes we also call it general ledger and nominal ledger. There are two types of account, real accounts and nominal accounts. Real accounts are the account which has a physical substance. Nominal accounts are the account which does not have a physical substance. Under nominal account, there are two accounts, expense and income. Expense is always a debit nature, income is always a credit nature. This is just a quick recall. If you want to understand details, you can watch the previous videos. Okay, so in this slide I'm going to give you a quick recall of how are we going to record. Okay, so how are we going to decide debit and credit side for the real type of account? For the real type of account, if it is in, it is debit. If it is out, it is credit. Okay, for the nominal type of accounts, if it is expense, it is debit. If it is income, it is credit. For the receivable account, if receivable is increased, we will record in debit side, because for example, if you make a credit sale to your customer, your receivable is increased. Okay, if receivable is decreased, we will record in credit side of the receivable account. For example, if your customer make the payment for the credit sale, receivable account is a debit nature. That's why if increase in receivable, we will record in debit side. If it is decreased in receivable, we will record in credit side. Okay. Payable. Payable is what? Credit nature. So for the credit nature types of account, if it is increase in payable, we will record in credit side. If it is decrease in payable, we will record in debit side. So what is the example of increase in payable? For example, if you make credit purchase from your supplier, what is the example of the decrease in payable? For example, you make a payment to your supplier, your payable will be decreased. Okay, so in next slide I'm going to give you an example of the transactions. This is just a quick recall of the previous video. That's why I'm explaining quite fast. If you want to know more details, you can watch the previous videos. So here in this slide I'm going to give you an example of the transactions. Okay, so for example, capital introduced. Okay, owner introduced capital into the business. So under double entry bookkeeping system, there are always two sides we need to consider. One is debit side, one is credit side. So owner introduced capital to the business. So owner is introducing cash. So we have to think what account we are going to open. Okay, owner introduced capital to the business. It means owner is giving cash to his business, so we have to open cash account. Okay, so what are the other accounts we are going to open? The other account we are going to open is capital account. Okay, because owner is introducing capital, so we will open capital account. What do we receive? What is business receive? Business receive cash, so that's why we open cash account. Then we have to think which sides we are going to record, debit side or credit side. In cash account is real type of account. Real type of account, cash account, owner introduced capital, business receive cash, so cash account is real. We receive cash, so it is in. so we will record in the debit side. Okay, capital account. What did I explain in previous slides? Capital is always a credit nature. Capital is what? Capital is always a credit nature. So capital is personal account. Okay, capital is what? Personal account. And the personal capital is, you have to think capital is related to owner or not related to owner. Capital, personal, owner related account, then we will record it in credit side. Okay, so how are we going to consider capital introduced? We will open cash account and capital account. Okay, cash account is under which type? Cash account is real type of account. So real type of account, business is receiving cash, so it is in, so we will record in debit side. Forget about the current asset for now. I will explain in later lessons about what is current asset. Okay, so capital is which type of account? Capital is personal. Under personal, we have two accounts, right? Personal, owner related and not owner related. So capital is owner related account, so we will record in credit side. One thing you can easily do is, if cash is debit, capital is definitely credit, because we only have two sides. One side is debit, the other side is credit. But you also need to know why are we going to record in the credit side. This is the reason why. Okay, capital is credit nature, so capital introduced is always recorded in credit side of the account. If owner introduced capital into the business, we will always record in credit side of the capital account. It can never be a debit, because debit we recorded in cash account debit side, right? So capital is definitely a credit. So why are we going to record? This is because this is the reason. This is because capital is credit nature, so capital introduced is always recorded in credit side. Okay, then the other example is drawing cash. Okay, drawing cash. What is drawing cash? Drawing cash is owner take some cash from the business for his personal use. Okay, so we have to think two accounts. Okay, what is owner taking? Owner is taking cash, so cash is out from the business. Then what is owner is, if owner takes something from business for his personal use, we call that drawing. Okay, so we will open cash account and we will open drawing account. We have to think which account, what account we are going to open. We will decide the account first. Okay, we will open, owner is taking cash from the business for his personal use. Because it is personal use, we will open drawing account. Then, what is owner taking? Owner is taking cash, so we will open cash account. Then we will decide under which side we are going to record cash. Cash is what? Real, right? If it is in, we will record in debit. If it is out, we will record in credit. Owner is taking cash from the business, so cash is out, so we are going to record in credit side. Okay, then drawing. So if we record credit side in the cash account, definitely drawing we are going to record in debit side. Okay, drawing account is what type of account? Personal. Owner related or not owner related? Drawing is owner related, so we will record in debit side. Drawing is always debit. Okay, drawing is debit nature, so drawing is always recorded in debit side of drawing account. Okay, then another example is cash sale. What is it? Cash sale. We are selling cash, so we will think what are the two accounts we are going to open. Cash sale. What is business receive? Business receive cash, so we will open cash account. And then what is the transaction? We are selling, right? So we'll open sale account. If it is cash sale, it's very easy. We'll open cash account and sale account. Then we will decide the side, debit side or credit side. Cash account. Cash account is real. it is cash sale, right? Business is receiving cash. So cash account, real in debit. Sale account. Sale is personal or impersonal? Sale is impersonal. Under impersonal, it is what? Nominal. Sale is nominal. Right? Under nominal, there are two accounts, expense and income. So sale is what? Income. So if it is income, we will record in credit side. Okay? So if I explain you guys this again, capital introduced. Owner introduced capital into the business. What are the two accounts we are going to open? Cash account and capital account. Cash account is real. Real, business received the cash, that's why it is in, so we record in debit side. Capital is personal, but it is owner related account, so we record in credit side. Capital is always credit. Okay? Drawing. What is drawing? Drawing means owner take cash for his personal use from the business. So we will open cash account and drawing account. Cash account is real account. Owner took the cash, so cash is out from the business. So it is out, we will record in credit side. Drawing account, personal, it is owner related, we will record in debit account. Because drawing is debit nature, so drawing cash is always debit side in the drawing account. Okay? Cash sale. Cash sale, if it is cash sale, we will open two accounts. Cash account and sale account. Okay? Cash account is real type of account. Business is receiving cash from this transaction. So it is in, we will record in debit side. Sale. Sale is nominal. Income, credit. Sale is income, right? It is not expense. We are receiving cash. So sale is income. Nominal, income, credits. Okay? So here in these slides, I'm going to give you more example. Okay? So, credit sale. In previous slide, we have cash sale. In this slide, the example is credit sale. We are selling in credit. What is the transaction? Transaction is a sale transaction. So either it is cash sale or credit sale. We will definitely open what account? Sale account. If it is cash sale, we will open cash account. If it is credit sale, what are we receiving? Do we receive cash? No, we don't receive. We sell something to our customer, but we are receiving cash later. So we need to open a receivable account. Okay, receivable account. Credit sale, what are the two accounts we are going to open? Sale account and receivable account. Sale account is nominal income, so we will record in credit side. Okay? Receivable. Receivable is what? Receivable is personal. Receivable is what? Personal type of account. Under personal type of account, we have to consider two. Whether it is owner related or not owner related. It is not related to owner, because under owner account, related account, there are only two, capital and drawing. This is not capital, this is not drawing. This is what credit sale, so it is not related to owner. Because of credit sale, our receivable account is increased. Because before the credit sale, we have zero. Now, we sell with the credit to our customer. So we need to record debit side. Okay? Don't look at the current asset for now. For now, you only need to understand is, if it is credit sale, you need to open sale account and receivable account. Okay? Sale account is nominal income, so it is always credit. Understand? Then credit sale. If it is credit sale, that's why we need to open receivable account. What account? Receivable account. Because we are not getting cash, so we need to record, we have to receive that amount from our customer. That's we call it receivable account. Receivable account is personal, not related to owner. So because of credit sale, receivable is increased. That's why it is debit side. In previous slide, I explained, right? Receivable account is debit nature. If it is increased, we will record in debit. If it is decreased, we will record in credit. Because of credit sale, receivable is increased. That's why we record in debit side. Okay. Then the other is cash purchase. What is it? Cash purchase. We are buying something in cash. Okay. It is cash purchase. So what do we see here first? We see cash, right? So what account we are going to open? We open cash account. What are the other accounts we are going to open? What is the transaction? This is the cash purchase. We are buying something. So we will open purchase account. Okay, so if it is cash purchase, what are the two accounts we are going to open? Cash account and purchase account. Okay. Cash account is real. We are buying something cash. So cash, we receive cash or we are paying cash. We are paying cash, right? So cash is out from our business. So real, out. So we will record in credit side. If we record credit side in the cash account, definitely in purchase we are going to record in debit side. But we need to understand why do we record in debit side. Okay, purchase is impersonal. Under impersonal, purchase is real or nominal. Purchase is nominal. Okay, purchase is what? Nominal. We cannot touch the purchase, right? So nominal. Under nominal, there are two types, right? Expense and income. Purchase is expense, so it is debit, right? Because we are paying something for this purchase, so it is our cash out transaction, so it is our expense. Okay, we are paying cash to get something, so cash is out, credit, purchase, nominal, expense, debit. In an easy way, if you decide one side, the other side is always debit. This is the easy way. If you can decide cash, real, out, credit, purchase, you will definitely record in debit side of the purchase account. But why are we recording in debit side? This is the reason why, because it's nominal, expense, debit. Okay? Then, this is cash purchase. This is what? Credit purchase. What is the transaction? It is the purchase transaction. Okay. Number 5 is a cash purchase. That's why we open cash account and purchase account. Number 6 is what purchase? Credit purchase. We are buying on credit. We are not paying cash. So it is credit purchase. That's why we will open purchase account. So the other account we need to consider. What are we paying? We are paying cash? No, right? Because we are buying on credit. So we need to pay something to our supplier later. We are paying later. So if we are going to pay someone later, we need to open payable account. Okay? So credit purchase, we will open purchase account and payable account. Purchase account is nominal, expense, debit. So if it is purchase is debit, definitely payable we are going to record in credit side. But we need to know the reason why are we going to record in credit side. Payable is what? Personal. Personal, it is not related to owner. Because of credit purchase, our payable increase or decrease. Before we don't have no payable, we have zero payable. Because we are buying something on credit, it will increase our payable account. So it is increase in payable. That's why we will record in credit. Okay. If you want to think in shortcut way, you can think about the debit side first, or either credit side. Okay. If it is credit purchase, we will definitely open purchase account. Because we are buying on credit, we will open payable accounts. Purchase is always debit. That's why purchase, nominal, expense, debit. If it is debit side in purchase account, definitely we will record the other side, payable account is credit. Okay, if I tell summary for this sheet, if it is credit sale, we will open sale account and receivable account. Sale account, nominal income, credit. We need to get something from our customer, right? Because of this sale, but customer will pay us later. So that's what we call receivable account. Okay, receivable account is personal. It is not related to owner. Because of credit sale, we have increase in receivable. So it is that we'll record in debit side. Okay, cash purchase. We will open purchase account and cash account. Cash is real type of account. Because of this purchase, we are paying cash to our supplier. Cash is out from the business. So it's real, out, credit. Purchase is nominal, expense, debit. Credit purchase. It is also a purchase transaction. So we'll definitely open purchase account. But we are not paying cash. We are buying on credit. So we'll open payable account. Purchase is nominal, expense. We will record in debit side. Payable, if it is debit side, and the payable account will definitely record in credit side. Okay, these are the reason why are we going to record under credit side, because payable is personal account. It is not related to owner. Because of credit purchase, our payable is increased, so it is increase in payable, so it is credit side. Okay, so I hope you understand this side also. Okay, so I'm going to give you more examples in these videos. Okay, the other example is we bought a computer by cash. Okay, what did we buy? We bought a computer by cash. So we need to think, what are the two accounts we are going to open? What are we buying? We bought a computer. What did we pay? We pay cash. So we'll open computer account and cash account. What are the two accounts we are going to open? Computer account and cash account. Okay, then we will consider which side we are going to record. Computer is real, right? Computer is under which type of account? Computer is real. Business bought a computer, so business is receiving a computer, so we are receiving the computer, so it is in. So real, in, debit. Real type of account, how we're going to record? If it is in, we will record in debit side. If it is out, we will record in credit side, right? So business buy a computer, so business receive a computer, so computer is real, we receive, so it is in, so it is debit. Cash account. Okay, cash account. Cash account is also a real type of account. We buy a computer by cash, so business is paying cash to get that computer, right? So real, out. If it is out, we record in credit side. As I told you in previous slide, if one side is debit, the other is definitely credit. Okay, if you can decide computer is real, in, debit, cash is definitely credit. These two real, out, we are considering here because we want you to know why do we record. It is the reason why we record in credit side. Okay, so business bought a computer by cash. What are the two accounts we are going to open? Computer account and cash account. Computer we can see, so it is real. Business received, so it is in, debit. Cash, it is real account, we paid cash, so it is out, so we will record in credit side. Okay, the other example is bought motor vehicle on credit. Bought motor vehicle on what? Credit. Business bought a motor vehicle, so what is the account we are going to open? It is sure we'll open motor vehicle account. The other account, do we pay cash? No, we don't pay cash. We buy a motor vehicle on credit, so we will pay our supplier later, right? So what is the account we are going to open? we will open payable account, right? Then we will decide debit or credit. Motor vehicle account is real. In we record in debit side. Okay, then payable account, if it is debit, we will definitely record credit side in the payable account, right? But I want you to know the reason. Payable account is personal and it is not related to owner. And not related to owner, we have two accounts, receivable and payable. It is payable. Payable is credit nature. Because of this motor vehicle purchase, it increased our payable account, right? If receivable payable account is increased, we'll record in credit side. Okay, so I will explain you again. We bought a motor vehicle on credit. We will open motor vehicle account and payable account. If we bought by cash, we'll open cash account. It is same like this. We are buying on credit. That's why we'll open payable account. Motor vehicle account, we can see, we can test the vehicle, so it is real. Business received that vehicle, so it is in. Then we'll record into credit side, debit side, sorry. Payable account is personal. It is not related to owner. Because of this credit purchase of motor vehicle, it increased our payable. That's why we record in credit side. Okay? If you don't want to think about this, it's okay, because if you can decide correctly, motor vehicle, real, debit, payable, we will definitely record in credit side. But you also need to know, why do we record? Because it increased in payable, that's why we record in credit side. You can double check, right? The other example is cash paid to creditor. What? Cash paid to creditor. We paid cash to our creditor. Creditor is also our supplier. Okay. Cash paid to supplier, cash paid to creditor. Because here we buy motor vehicle on credit, right? We also see an example of credit purchase. We buy on credit, we have to pay our supplier in later period, right? Maybe in next month we are going to pay. So we need to consider what are the two accounts we are going to open. What did we pay? We paid cash, so we'll open cash account. Okay, then another account we are going to open is payable account. Okay, when we bought a motor vehicle on credit, we open payable account, right? Now we are paying back to our supplier, so we need to close that account, right? So the two accounts we are going to open is cash account and payable account. Cash account, real, it's very easy. We paid cash, so it is out. If it is out, it is credit. If it is credit, definitely we are going to record debit side in the payable. But why? Why do we record in debit side? We need to know. Okay, you need to understand. This is just for your understanding. If you can decide this cash, real, out, credit correctly, you will definitely record debit side in the payable account. Payable account is personal. Under personal, it is not related to owner, right? Because we paid cash to our supplier. We owe our supplier before 500, let's say. Now we are paying them back. So this will decrease our payable. Because of this cash paid to supplier, it will increase our payable or decrease our payable. It will decrease our payable. Payable is credit nature. If it is increased, we will record in credit side. If it is decreased, we will record in debit side. Okay, so I will explain you this again. We paid cash to our supplier. We will open cash account and payable account. Cash is real. We paid cash, so it is out. So we record in credit. Payable. Payable is personal, not related to owner. because we paid cash to our supplier, it will decrease our payable, so we'll record in debit side. Okay, I hope you understand up to here. So here in this slide, I'm going to explain you more examples of double entries and transactions. Okay, so sale return. What is sale return? We also call it return in what? Sale return is something our customer return it back. We sold to our customer, maybe because of some defaults or maybe because of some error, they return back to us. This is what we call sale return. Return in what? When we record the sale, we record sales, nominal, income, credit. Sale return is reverse of sale. Sale is nominal income. Sale return is nominal expense. Okay, so how are we going to record sale return? The detailed definition of sale return and return in what I will give you in next lessons. Okay, so for now you just have to understand is sale return is opposite of sale. We record sale as nominal income credit, so sale return is nominal expense debit. Okay, so for sale return transaction, what are the two accounts we are going to open? Sale return account and receivable account. Sale is always related to receivable. Okay, so under sale return account, as I told you earlier, sale return is opposite of sale. Sale is nominal income credit. Sale return is nominal expense debit. Okay, because of sale return, what will happen to our receivable account? It will have a decrease in. What will happen? It will have a decrease in. Receivable is debit nature because the customer return goods back to us. For example, we sell a worth of $400. Customer return 100. So we need to reduce 100 to the receivable account, right? So under receivable account, in which side we are going to record under receivable account? We will record in credit side. Okay, why do we record in credit side? Receivable is personal, not related to owner. Because of sale return, it is decrease in receivable, so we record in credit side. Okay, the other example is purchase return. We also call it return outward. Sale return is customer return back to us, right? Purchase return is we return back to our supplier. We buy something, maybe if there is some error or some default, so we are going to return that to our supplier. Okay, sale return is opposite of sale, so purchase return is opposite of purchase. Purchase, we record purchase nominal expense debit. Purchase return is nominal income credit. Okay, so it is a purchase return. So what are the two accounts we are going to open? Purchase return account and payable account. Purchase return is opposite of purchase. So purchase return is nominal income credit. If it is credit in purchase return account, we will definitely record in debit side of the payable account. The other side is debit in payable account. So payable, we record here purchase return credit side, right? But payable under payable account will definitely record in debit side. But we need to know why are we going to record in debit side. Payable account is personal, not related to owner. Because of purchase return, it decrease or increase our payable. Let's say, for example, previously we have to pay our supplier 400. It's 400 is payable under our payable account. Now we return 100 USD already. So we don't need to pay 400 anymore. We need to reduce 100 USD. So it will, because of purchase return, it will decrease our payable account. Payable account is credit nature. If it is increased, we will record in credit side. If it is decreased, we will record in debit side. Okay. The other example is rent paid. Rent paid by cash. What are we paying? We are paying rent. How are we going to pay? We are paying by cash. So what are the two accounts we are going to open? We will open rent account and cash account. Rent account is nominal. It is expense or income. Rent is we are paying cash, right? So rent is an expense. Rent is nominal, expense, debit. Cash is real, out, credit. Okay. For example, here, let's say we are paying interest. If it is interest paid by cash, we will open cash account and interest expense account. We are paying cash, right? So cash is real, out, credit. Rent or interest is nominal, expense, debit. Okay. I hope you understand up to here. So the other example I am going to give you is interest received by cash. What is it? Interest received. Okay. So what are we receiving? We are receiving interest. How? We are receiving cash. So we will open cash account and interest received account. Cash is real. We are receiving, so it is in. So we will record in debit side. Interest income. Income is nominal, income, credit. Okay. So let's say we are receiving a commission by cash. So we'll open cash and commission account. We are receiving, right? We are receiving something. We are receiving an income. So we'll record in our income account. Okay. So if we receive interest, we'll open cash account and interest income account. Cash account, we receive cash, real in, debit. Interest income is nominal. It is income, that's why credit. Okay. So I hope you understand up to here. In next slide and next video, I'm going to give you an example of the T accounts. For now, you need to understand all these examples. You need to understand what are the two types of ledgers and how are we going to record. Okay, this is the basic double entry you need to know. Everything will be based on this concept. If you understand this 13 example, it will be very easy for you for next lessons. Okay, thank you so much for watching.